Welcome to the channel JIV and CIV Made Simple. Today we are going to discuss our unit number 26 of AFM. Chapter name, as you can see, is equipment leasing. So let's get started with our basic concept, that what is the meaning of lease. First of all, let's understand what a lease means in the simplest word. You know what happened? That when a business needs things like machine, vehicle, building, it must decide how to get them. Right? So one way is buying. Right? One way of doing it is buying. So, but sometimes business don't have enough money, and it is smarter not to own. Sometimes what happens that business don't have enough money, or it is smarter not to own something. That is where leasing comes into picture, right? So lease is a legal agreement where the owner, who is called the lessor. So if we talk about the lease, this is a kind of legal agreement. On one side you will see in the lease we have owner, right? So owner, we can also call owner as the lessor. This is also called the lessor. Right, it lets someone who is called lessee. It lets someone who is called lessee to use an asset. So he will use an asset for a fixed time. So lessor and lessee. Lessor is the owner and lessee is someone who used the asset for a fixed time. Right. So in return, the lessee pay regular amount called lease rental. So obviously something the lessee has to pay. So lessee has to pay what? Lessee has to pay regular amount, that is called lease rental. Right. So remember, this is the very important point. So the asset can be anything, right? The asset can be anything. It can be fixed, it can be movable asset, it can be anything. You can say fixed or movable asset, right? So fixed means what? Like a building. Fixed means like a building. And what are the movable asset? So if we talk about the movable asset, it can be like vehicle, or it can be like machine. So fixed can be building, or movable asset means vehicles or machine. And this is all about asset. Now lease contract. Lease contract says how the asset is used. So if we talk about the lease contract, it said that how the asset will be used and how the payment are made for that specific period. So it contains detail about the for use of the property and regular payment for a specified period. That is all about lease contract. It said how the asset is used and how the payment are made for that specific period. So basically, to summarize, we can say use the asset, follow the rules, pay the rental, ownership usually stay with the lessor. Right. So some terms are here. Financial management, you are familiar with it. It means planning how to get and how to use money wisely in a business. Fixed asset, you know it very well. Leasing means letting someone use an asset for a time. Lessor, lessee, lease rental, these three terms you must know. Lessor means, what is the meaning of lessor? Lessor means the owner of the asset who rent it out. Lessee means the person or the business that use the asset and pay. And finally, we have fixed or movable asset. So fixed means it stays in one place like a building. Movable means it can be moved like car or machine. Lease contract means the agreed regular payment the lessee make to the lessor. And then we talked about the legally binding contract. So what is the meaning of this term legally binding contract? Which is a kind of written agreement that everyone must follow. It explains right, duties, payment terms. We also talked about a specified period, right? The exact length of time the asset can be used. For example, imagine you need a car for 2 years. Suppose you need a car for 2 years, right? But don't want to buy it. So the car owner, who is called the lessor, right? He let you drive it for 24 months, right? If you pay 10,000 rupees every month. If you pay 10,000 rupees every month, the car owner or the lessor will let you drive it for 24 months, right? Is it clear? I hope it is clear right now, right? So if you pay 10,000 rupees per month, then the car owner let you drive it for 24 months. So here you are lessee, right? You are lessee. So you use the car and pay monthly rental. The owner is still legally on the car unless the contract say otherwise, right? So remember, lease means what? Use now, pay regularly, right? Just to summarize what we learned in this particular slide, just remember, lease, whenever you see this word lease, it means use now and pay regularly, right? That is called lease. Then lessor is the owner, or means he is the owner, and lessee means lessee is the user, and lease rental is the monthly and regular payment, right? So lease is a kind of legal contract to use an asset for a set time in return for lease rental. Lessor is the owner, lessee is the user. Asset can be fixed, asset can be movable, and leasing is used when buying is not possible or not financially sensible. And lease define use rule, payment schedule, and a period. Now let's talk about the types of leases that we have. So basically, that lease may be residential, which means home based, right? So this is lease can be residential, or lease can be commercial, which means business use. So breaking a lease can have legal consequences, so you must follow the agreement. So since it has legal consequences, so agreement must be followed. And under the accounting rule, what is the accounting rule? IND AS 116. Under this, as per this accounting rule, lease are usually classified as operating lease or finance lease. So these are the two ways that lease are classified. One is called operating lease, second is called finance lease, right? They affect how they appear in the finance book. Now, if you talk about the commercial lease, let's talk about the commercial lease. Commercial lease have many subtypes. They are categorized as a leverage. You can see leverage, domestic, international, cancelable, non-cancelable, sales and leaseback, etc. So let's get started with the leverage lease. What happened in the case of leverage lease? Just have a look. So basically, in the leverage lease, the owner or the lessor, he borrow money to buy the asset, then rent it out to the lessee. So the owner or the lessor, what he does, he borrow money to buy an asset and then rent it out to the lessee. That is called leverage lease. Second is a domestic lease. Domestic lease is what happen, when both parties are resident in the same country, right? So if you talk about the domestic lease, it means, both parties are resident in the same country, that is domicile in India. Then it's called domestic lease, right? So for example, India. And then we have international lease. What is the meaning of international lease? International lease involves parties in different countries, right? International lease involve parties in different countries. What is the meaning of cancelable lease? Cancelable lease means, as the name suggests, that it can be ended as per the contract. And non-cancelable lease means what? It means it has limited or no early exit. What is the meaning of wet lease? Wet lease means lessor also provide operation, right? Lessor provide, in the case of wet lease, lessor provide operation, okay? Lessor provide maintenance, lessor provide insurance. And in dry lease, what happened? In the dry lease, lessee take care of those. So try to understand, lessor is the person who is the owner. In the case of wet lease, lessor operate the equipment and is responsible for maintenance and insurance. And in dry lease, lessee is responsible for these kinds of function. And then we have, sales and leaseback transaction. What happened in this case, that in the case of sales and leaseback, a company sell an asset, right? So what happened, it involves selling an asset to whom? Companies sell an asset like a building and immediately rent it back so that it can keep using it. Be careful. Sales and leaseback deal have sometime been criticized for putting very high value on poor or junk asset. So that covers the main type, right? So first of all, what we have discussed in these two slides, we talked with the residential. Residential means what? Renting for living purpose. Commercial, like renting for business purpose. Operating lease. Operating lease means like, simple, like renting, right? The lessee record lease payment as an expense. Then we have the finance lease. So what happened in the case of finance lease, so the second example is called the finance lease. Finance lease means it is closer to buying, right? Finance lease is closer to buying, which means lessee record the asset and a borrowing liability, right? What happened in the case of finance lease, that lessee record the asset and the borrowing liability. What is the meaning of leverage lease? Leverage means what? Lessor borrow part of the money to buy the asset and use the lease income to pay back the loan, right? So lessor does not borrow the entire asset. Rather, he borrow the part of the asset and pay back the remaining via the loan. And he use the lease rental to repay the loan. That is leverage lease. Then we have domestic. Leverage means what? He has taken debt. Simple word. Whenever you see this word leverage in the context of finance, it means debt. Now what about domestic lease? Domestic means both parties are registered in the same country. International means, at least one party is abroad. Cancelable lease means contract allow early termination under the said term, right? Contract allow early termination. So if the contract allow early termination, it's called cancelable lease. And on the other hand, we have non-cancelable lease. What happened here, contract cannot be easily ended early. Commitments are quite strong. What is the meaning of wet lease? Wet lease means lessor supply the asset plus operation and maintenance. For example, aircraft with crew and service. So one example you can take of wet lease like aircraft, right? So lessor supply the equipment and is responsible for maintenance and insurance. Then we talk about the dry lease. What is the meaning of dry lease? So lessor supply only the asset. Lessee operate and maintain it. Sales and leaseback, which means owner sell an asset to another party and then rent it back. And junk asset, junk asset, sometimes the sale price is unrealistically very high, which can mislead investor about the true value. So let me give you some simple example of the leverage lease. So one example of leverage lease can be like this. Think of someone who borrowed to buy a taxi, then rent it out to driver every day. The owner uses the rent to pay the loan. Then if we talk about the wet versus dry lease, let's have an example. Like aircraft. A wet lease is an airline leasing a plane with pilot and crew. And a dry lease is leasing just the plane. Right? Your airline provide the crew. So when you are leasing just the plane, that is called dry lease. And your airline will provide the crew. While wet lease is that you are leasing a plane with pilots as well as crew. That is called wet lease. Which means lesser is responsible for everything. He will provide equipment. He will provide maintenance. Like aircraft, you are just leasing a plane with airline leasing a plane with pilot and a crew. Now let me give you one example of sale and leaseback transaction. Suppose there is a shop, and what it is doing? It is selling a building to a bank. Shop is selling a building to a bank. For what? For cash. Bank is paying cash, right? And then contribute to operate in the same building by paying rent to the bank, right? That is called sales and leaseback. So you sell an asset to another party and get lease it back, right? So basically residential means home, right? Commercial means business, and operating versus finance affect accounting. So let's quickly revise the keywords. Lease can be residential or commercial. INDES, just remember this INDES, very very important. INDES 116, it group leases as operating or finance. Then we have commercial lease, which includes leverage, domestic, international, cancelable, non-cancelable, all other different types of commercial lease. Leverage lease, what happen? Lesser borrow to buy the asset, right? Lesser borrow money to buy an asset, that is called leverage lease. Domestic lease means both parties domicile in India, right? Wet lease, what is the meaning of wet lease? Wet lease means lesser provide operation or maintenance, and dry lease means lessee does all these things. And sales and leaseback give immediate cash but may open to misuse if asset values are inflated. Now let's talk about the finance lease. You know what is the meaning of finance lease? So let's understand about what a finance lease means. A finance lease is sometimes also called a capital lease. It is also called, it also called capital lease or sale lease. Finance lease. Finance lease is also called a capital lease. Here the lessor buy the asset specifically for the lessee to use for an agreed period, right? So what happened here? The lessor buy the asset for lessee use for an agreed period, right? So basically the deal is set up so that in substance the risk and reward of the ownership move to the lessee. The risk and reward of the ownership move to the lessee, right? Sometimes the lessee get an option to buy the asset at very low price, right? He get an option to buy the lessee get an option to buy the asset at very low price, which is called bargain price. And basically, and the lessee is expected to use that option. So he gets to buy the asset as very low price, that is also called the bargain price. You can see clearly written a substantial low price. And in finance lease, the lease term usually cover a major part of the asset economic life. So lease term cover a major part of the economic life of the asset. And you use the asset for most of the time, it will be useful. Because of this feature, a finance lease is really a way of providing finance, right? The lessor buy the asset and the lessee effectively get the benefit of ownership even if legal title stays with the lessor until later. And there is a accounting rule which is called accounting standard INDES 116. So a finance lease is one that transfers substantially all the risk and reward of ownership to the lessee, right? It transfers substantially all the risk and reward of ownership to the lessee, right? Now let's look at some keywords here. So we started with finance lease or capital lease, which is a lease structured so that the lessee get nearly all the benefit and the burden of owning an asset. Who get all the benefit? Obviously lessee. Lessee is getting all the benefit and burden of that asset. Who is the lessor? Lessor is the party who buy the asset and leases it out. So lessor, what he does, he buy the property, he buy the asset and then leases it out, right? Who is the lessee? Lessee means the party who use the asset and bear the most risk and reward. So most risk, most reward is beared by the lessee. I think we have discussed it. So then we have the word called risk and reward of the ownership. Things like earning the asset remaining value, bearing wear and tear, handling running cost or residual value risk. All these are borne by the lessee, right? Then we have an option that is called bargain purchase option. What is the meaning of this term bargain purchase option? Basically, a right for lessee to buy the asset at very low price at the end of the lease. right? So lessee can buy the asset at very low price at the end of the lease. That is called, bargain purchase price. One more point says, major part of the economic life. Here you can see a major part of the economic life. What is the meaning of it? It means the lease period cover most of the time the asset will be useful, not just a short rental. And then this INDAS 116, just remember it. If the lease passes test shows the lessee get almost all the risk and reward, it is finance lease for accounting. So let me give you a simple example to illustrate this, how it works. Suppose there is a bakery, right? Think of a bakery, and this bakery, they need an oven worth rupees 10 lakh, but they cannot pay now. They cannot pay now, right? So a finance company called the lessor, right? Here what will happen in this case, a finance company, right, that is called the lessor, right? He buy the oven and leases it to the bakery for 8 years. So it leases the oven for 8 years, right? At the end, the bakery can buy the oven at the end of 8 years. That particular bakery, they can buy the oven for just how much? 10,000 rupees. Now it is taking 10 lakh, and after 8 years it's just 10,000 rupees, which is called bargain. This is called, bargain, right? So the bakery uses the oven, pays the lease installment. Obviously, bakery interns will pay installment to the finance team, right? And takes on most running risk. So for practical purposes, it's like owning the oven even if legal title move later. Legal title is moving later. Almost it is similar to owning the asset. So finance lease is just like, buying. Lessor buy, lessee uses and bear the risk, right? These are the keywords. So first point to remember is that finance lease is also called the capital lease, right? A lease that transfers substantially all the risk and reward to the lessee. Second point, lessor buy the asset for the lessee use. The lessee effectively take economic ownership. Ownership often transfer at the end of the lease, right? It has bargain purchase option. And then, lease term cover major part of the asset economic life. INDAS 116 treat leases that transfer these risk and reward as finance lease for accounting. Now friends, let's have a look at the next slide. So now we will see how accountant decide if a lease is really a finance lease and what an operating lease means. Two things we will discuss. How accountant decide that if the lease is a finance lease or not. There are some clear signs that point to finance lease. So friends, now let's look at those signs which points to the finance lease, right? First of all, if the present value, see the first point, if the present value, right, if the present value of the lease payment at a start, that means the value today of all the future lease payment is equal to or more than the fair value of the asset, right? So what I mean to say, that you find the present value of lease payment, right? So if you find the present value of lease payment, right, if it that means today's value of all the future lease payment. Obviously lessee has to make the lease payment, right? So you find the present value of that, and if it is equal to or if it is more than the fair value of the asset, if it is, then that is a red flag for finance lease. It is a kind of red flag, right? This is the first thing that you should note. Second point is that if an asset is specialized, here you will see the keyword written specialized. Suppose the asset is specialized, which means built or adapted only for that lessee, right? That means that particular lessee only can build and access. So if the asset is specialized, it can't be used by other. So the lessee effectively get ownership like benefit, right? So what I mean to say, that if an asset is specialized, right, so it cannot be used by another because it is customized to be built by a particular lessee only. No one other can use it, right? So lessee effectively get ownership like benefit. Third point is that if the lessee can cancel, right? If the lessee can cancel but must pay the loss to the lessor, it shows the lessee bear the downside risk. Yes. So basically this downside risk is borne by the lessee. Fourth point is that, let's have a look at the next point in the next slide. So fourth point says that, if the lessee can keep using the asset after the first term at a much lower rent. So here the keyword is a substantially lower rent, right? So if the lessee can keep using the asset after the first term at much lower rent than the market, then renewal is like a bargain. This is another sign the lessee get most of the benefit. So on the other hand, we can say an operating lease does not transfer substantially all risk and reward of ownership. It is more like a true rental. The lessor keep most ownership risk and reward. Remember, lease classification depends on the substance of the deal. Right? So lease classification depends on the substance of the traditional deal, not just the word on the paper. And that judgment is made at the start of the lease. And judgment is made at the inception date or the start of the lease. Also, operating lease can be wet or dry lease. Operating lease can be wet lease or it can be dry lease, right? Depending on whether the lessor provide operation, maintenance, insurance or not, right? So friends, what we have discussed, let me just summarize. Let me give you some example to make it more clear. So we started with, PV versus fair value, right? So the first discussion we did was regarding the present value versus fair value. What I told you, that suppose the machine market price today is 1 lakh. Suppose machine market price today is 1 lakh and discounted value of all the lease payment is 1,05,000. This is the discounted value, right? Now the payment cover the whole cost. That is the point to the finance lease, because this is the market price. This 1 lakh is the market price today, and discounted value of all the lease payment is 1,05,000. Obviously, present value is larger than the market price, so it simply means the payment cover the whole cost, right? The payment cover the whole cost. That point to the finance lease. This was the first point. Okay, this is a kind of red flag. I told you, na. This is a kind of red flag. Let me again come back to it. Here we can see, if the present value of the minimum lease payment at the inception of the lease equal to or exceed the fair value of the asset, right? This is a kind of red flag. So this indicate to the finance lease. Second thing is the specialized asset, which means a factory make a press that only one buyer can use. The lessee is effectively the owner for practical use, isn't it? Next point is bargain renewal. Here you will see the word so-called bargain renewal. So what is the meaning of this term bargain renewal? It simply means you rent a shop for 5 years and your contract let you stay another 15 years at rent far below the market. So you have locked in near ownership benefit, right? So operating lease example can be hiring a taxi for day. You use it, but the taxi owner still handle long-term risk and value, right? So what we learned from this discussion is that first of all, you find the PV, present value of the lease payment. If it exceeds the fair value or the market value, it clearly indicate to what finance lease or capital lease. This is the indication. Second point I told you about specialized lease or bargain renewal. Here ownership like structure is there, and operating lease is like true rental, right? So a specialized lease, a specialized asset, lessee bearing cancellation loss, or a low rent renewal option are a strong indicator of finance lease. Operating lease we have just discussed. Substance over form discussed. So basically this classification is based on economic reality decided at the inception date. Now friends, let's talk about the operating lease. So we have already discussed when a lease is classified as an basically operating lease. Yes, have a look at this particular slide. So friends, how to tell an operating lease from a finance lease, and why firms lease at all. So basically, a lease is usually called operating lease when the lease period is much shorter than the asset useful life. So here the key point is if lease term is substantially less than the economic life of the asset, right? This is the condition. So or when the lessee can cancel without paying big penalty. So lessee can cancel the lease without paying any substantial penalties, right? So basically, one common reason firm choose operating lease is to look less leverage. Yes, this is the major reason, right? A common reason why firm choose operating lease is to look less leverage. This is the reason, right? Which means the lease obligation used to sit off the balance sheet. So debt equity ratio stayed lower and borrowing capacity look stronger. So what happened, DER, debt equity ratio, since, leverage is less, so debt is less, so DER is less, debt equity ratio looks stayed lower, and obviously borrowing capacity looks stronger. But remember, under finance lease, so this was about the operating lease. Why they opt for operating lease? One reason I have just told you. But remember, if you talk about the finance lease, right, so the asset and a matching liability are shown in the balance sheet, so that make it harder for the firm to raise more loan. See, operating lease, you'll not show in the balance sheet. Right, you can see now it is written clearly here. It is not reflected as a debt in the balance sheet, right? But if you talk about the finance lease, then you have to show the value of the asset and the liability. It must be included in the balance sheet, right? And because of that, make it harder for the firm to raise more loan because the DER is actually higher. So it become difficult for the firm to raise more loan. So that is one advantage of having the operating lease. You need not show in the balance sheet, and since you did not show in the balance sheet, so DER will remain small, right? So leasing also has practical advantage, right? Like lower initial cash outlay. This is one of the practical advantage. Easier access to full finance, right? You have availability of full finance. Then more convenient access to the asset. You can see more convenience is there, access to the asset, right? And some more points are there. More convenient access to the asset. So leasing can save cash, speed things up. And leasing can be useful when the asset is needed for only a short time, right? So what we talked about just now, we started with the operating lease. Whenever you see this word operating lease, just remember it, that it is a rental where you use the asset for a short time and the owner keep most of the long-term risk and reward. Then we discussed the lease life and lease term versus economic life, these two terms. Lease term means how long you rent. Economic life means how long the asset is useful. Understand the difference between these two terms. Lease term is how long you rent. And economic life means what? That how long the asset is useful. If the lease term is much shorter than the economic life, it is usually an operating lease. So this is a way to identify an operating lease. So how long you rent is less than the economic life, which means how long the asset is useful. Then it clearly indicate what? It clearly indicate operating lease. One more point is cancel without penalty. What does it mean? So if the lessee, if the lease or if the lessee can end the lease easily without big cost, so that points to the operating lease, right? So this is another way to identify the operating lease. Suppose that lessee can end the lease easily without the big cost. That is called cancelling without penalty. That's called the operating lease. Now balance sheet and debt equity ratio. I told you that buying an asset or using a financial lease usually leads to showing both an asset and liability on the balance sheet. That raises the firm reported debt and can worsen the debt to equity ratio. And then there is something called off balance sheet advantage. Yes, this is one of the major benefit, but we call it off balance sheet advantage. Historically, operating lease were often not shown as a debt on the lessee balance sheet. That improved the borrowing ratio. That improved the debt equity ratio, right? That is one benefit of operating lease, that it is not shown on the balance sheet. So it improved the borrowing ability. Now one more point is lower initial cost, which means leasing let a firm use expensive equipment without paying the full price upfront. This is one of the peculiarity of leasing, that initial cost is very low. It let the firm use expensive equipment without paying the full money. That is one peculiarity. Now the next point is margin money and full finance. Here you can see margin money and full finance. What does it mean? That leasing often does not require large down payment. That is large margin money. Okay, this is one of the peculiarity of leasing, that it does not require large margin money, the way some bank loan do. Now convenience and speed. So leasing can be quicker than buying or arranging a term loan because the paperwork and approval can be simpler, right? So let me give you some example of the short term use, like operating lease. Operating lease, it is for short term. So you suppose you rent a high end camera for 3 months shoot. So the camera useful life is 5 years. So this is a kind of operating lease. Then let me give you some example of borrowing capacity. So what is borrowing capacity? Suppose if a small firm leases a machine as an operating lease, its balance sheet may show a less debt than if it is borrowed to buy the machine. So making the bank ratio look healthier. So buying a printing press take week of approval and big down payment. Leasing it can get the press to your factory in days with little upfront cash. So we can see that what we learned from this discussion is that, let me just summarize. Just remember, whenever you see this word operating lease, it means short rental, right? The rental is quite for short time, and their lower penalty. If you want to exit, you have to pay lower penalty. This is peculiarity of operating lease, right? Then if you talk about the finance lease, so finance lease, yeah, right. I told you that asset plus liability, they have to be shown on the balance sheet, right? So why we lease? What is the advantage of leasing? So first of all, low upfront cost. This is one of the key advantage. you have to pay low upfront cost, and second one is faster, third one is full finance. You get full finance. These are the three benefits of leasing, right? So what we learned from this discussion is that, let me just summarize. I told you that operating lease means lease term substantially, right? Lease term substantially less than economic life or cancelable without big penalty. These are the two peculiarity of operating lease. Operating lease will get traditionally off balance sheet, improving debt equity ratio. Finance lease put assets and liability on the balance sheet. Main benefit of leasing are lower upfront cost, right? Then availability of full finance. You can get access to full finance, lower initial cost, right? Margin money is very less or no margin money. Convenience is there, speed is there. So remember, classification on substance and modern accounting reduces some off balance sheet advantage. So I hope the concept till now is clear, crystal clear. Move forward to some more advantage of the leasing. You can see in the next slide we are talking about the some more advantage of leasing. So friends, the three big reasons that firm choose leasing is avoiding obsolescence. Yes, this is one of the major useless quickly. Leasing let the firm pass that risk to the owner. Yes. So basically what is happening, that risk passed to the owner, right? That is called avoiding the risk of obsolescence. Now what happened, basically that owner is also called, lessor. So risk passes to the lessor instead of being stuck with an outdated machine. And there can be tax advantage also. Tax advantage also happen in the context of risk, in the context of this, leasing. How tax advantage happen? Let me explain. So often lease payment are treated as business expense. So that these lease payment, how they are treated. Lease payment, they are treated like an expense for the business. Okay, and this can reduce the taxable income. But note, in many lease structure, the lessee cannot claim depreciation on the asset. So lessee cannot claim tax advantage of depreciation. Okay, that benefit goes to the owner. So whether leasing or buying gives a bigger tax shield depends on the amount as well as the timing. And a third thing is that giving the financial flexibility and a better cash flow. This is the third reason, third advantage of leasing. That firm can acquire asset with little or no upfront payment. They can match rental payment to their income cycle, and they can choose lease term that fit seasonal demand or expansion plan. Finally, lease use something less restrictive covenant. What does it mean? Than the bank loan. You may avoid limitation like dividend ban, right? So there are some limitation on the payment of dividend. You may avoid it, dividend ban, or tight managerial condition. Okay, then you may avoid the personal guarantee. So the bank often require all these things, but you can avoid all these things. You can avoid this limitation. So lease usually carry less restrictive covenant. Okay, so I hope it is clear till now. So what are the main points I told you? That the risk of obsolescence, lease payment as so lease risk of obsolescence. One example can be, right, when technology or design changes fast. Owning can be risky. Leasing shifts the risk of losing value to the lessor. Then lease payment as tax expense, tax advantage. So many tax system, they allow lease rental to be deducted as business expense, lowering the taxable profit. Then we talk about the depreciation versus lease deduction, right? Depreciation versus lease deduction. I told you that depreciation is a kind of tax deduction for owning an asset, right? Depreciation is a kind of tax deduction for owning an asset. If the lessee cannot claim depreciation because the lessor is the legal owner, right, then the tax benefits shift to the lessor, which may or may not be better for the lessee depending on timing and size. Then we talk about the financial flexibility. So it means lease let firm avoid large upfront cost and choose payment schedule that match their revenue pattern. So some simple example to think about it, like suppose I tell you about obsolescence. Like suppose there is a software company that need high-end server that is likely get outdated in 2 years. So take the example of software company. Okay, this software company, they need high-end server and this will get outdated in 2 years. So leasing let them upgrade later without being stuck with the old server, right? Using leasing, they can update with the newest server. Tax choice. For example, let's take one example of company A. To understand the concept of tax, how it is helpful, let's take the example. Let's take the example of company A. So company A buy a machine, okay, and claim depreciation over 10 years. So claim depreciation over the 10-year. Company B, what it does, company B leases it, right? Company B leases the same machine and deduct lease payment today. Company B, so company A buy a machine and claim depreciation over 10 year, and company B leases the machine. It does not buy, it leases the machine and deduct lease payment today, right? And deduct the lease payment today. So tell me which one is better, A or B? Think about it. So it depends on which give bigger tax savings sooner. There is no one size answer. I can't tell that A is better or B is better. It depends on it depends on which give better tax savings sooner. As means earlier. Sooner means earlier. That is the point. That's called tax advantage. Then we have cash flow match. Like a mango pulping firm, they need extra packaging machine only during the 3-month harvest. So leasing for that season is cheaper and easier than buying. Then we have a word that you might have listened here, covenant. You know what is the meaning of this covenant? So covenant means, a bank loan might demand the owner personal guarantee and restrict dividend, right? So, the bank loan, what it demands? A bank loan demands owner personal guarantee. It demands owner personal guarantee, right? And restrict dividend. A lease may not give management more freedom, right? So lease means avoid obsolescence. Lease rental are often tax deductible. Leasing have low upfront cost and more flexibility. So what we have discussed in these two slides, let me just summarize. I told you about leasing. So leasing help pass the obsolescence risk to lesser for fast changing equipment. Second point, lease rentals are often tax deductible. Depreciation belongs to the owner, which is better depending on timing and amount. Leasing give financial flexibility, right? Lower upfront cost, payment schedule that matches the revenue and quick access to the asset. And leases often carry few restrictive covenant, right? Leasing often carry less restrictive covenant than the bank loan, but they still create payment obligation. So always read the lease term to know who bear maintenance, insurance, tax and obsolescence risk. Now let's talk about the content of the lease agreement. Very, very important aspect. Let's open a lease agreement and see what it must contain in simple English. So a lease agreement is a written document between the owner or the lessor and the user, which is the lessee. So the lease agreement record everything you have agreed about the asset. It's like a rule book, right? If we talk about the lease agreement, it's a kind of rule book, right? It's a kind of rule book. Okay. So it is carefully written to cover possible future situation. Typical item that you will find in the lease agreement includes who the parties are, right? First of all, it will include who the parties are, right? And any third party such as lender or supplier in the leverage or tripartite deal, right? Who the parties are. Is there and is there any third party such as lender or supplier in a leverage or tripartite deal? A clear description of the asset and whether the manufacturer warranty apply or not. So there is a clear description of the asset, right? And whether manufacturer warranty applies or not. The contract should state when the asset will be delivered, when the asset will be installed, right? So it will state that when the asset will be delivered at this time, the asset will be installed at this time, right? And what happened at the end when it is returned. This is also written, okay? What happened at the end when it is returned. Contract clearly stated. In the agreement it is clearly written, right? The contract should state, okay, and then more money matter. Money matters are clearly spelled out, which means securities or initial deposit, right? So money matter like is there any initial or security deposit? Clearly spelled out. Monthly lease rental, payment due date, interest on security deposit, right? Everything should be clear. And the agreement must say whether the asset ownership can move to the lessee at the end or not. Whether the asset ownership can move to the lessee or not, right? The agreement must say. Finally, it should be clear who pay for repair, who pay for alteration, insurance and government dues. It should be clearly written, right? So what are the points we have talked just now? We have talked about the parties involved, right? First point we have talked about is the parties involved, which means that names and address of the lessor and lessee. In the leverage or tripartite, lessee includes the financier or equipment seller. Then we talk about the tripartite agreement, which means a three-way agreement, lessor plus lessee plus financier or supplier, often used when lessor borrow or to buy the asset. Then we have asset depreciation. Asset depreciation, clear details should be there. Asset description, right? description of the asset, it should be clear detail. Then we have manufacturer warranty. What is the meaning of manufacturer warranty? It means whether the original warranty is valid and who handle the warranty claim. Then we have delivery and installation. Delivery and installation means when and who will deliver and install the asset. Effective date and primary period. Effective date and primary period. It means what? So the start date and the main lease term. Renewal term. Renewal terms means whether the lease can be extended and on what terms. Then we talk about the security and initial deposit. Security and initial deposit, which means the refundable amount held as security and condition for return. So you can think of the leasing as leasing a photocopier for your office. Let me give you one example to make it more clear. Suppose you are leasing a photocopier for an office, right? So the contract name your company, the copier owner, list the copier model and the serial number. It says that copier will be delivered and installed on 1st October and lease run for 36 months. It shows 20,000 security deposit, monthly rent of 4,000 paid on the 5th, and that the copier owner will insure the machine while your office pay the paper and toner. At the end, the agreement explain whether you can buy the copier or must return it. So that is the point. Everything should be clear. So what we discussed in this slide, I told you that lease agreement is a kind of written contract that govern the lease and it must be carefully drafted. It includes the party, it includes tri-party, right? It is you have to specify the delivery, installation, effective date, primary method, renewal term, spell out the security deposit, lease rental, payment term, interest on deposit, right? State ownership transfer condition, etc. etc. Now friends, we will cover important contract and legal point you must never miss in a lease. Lease should list activities that the lessee must do. For example, subleasing the asset to someone else without permission, right? So subleasing the asset to someone else without permission, the activity not permitted by the lessee, right? So it must also say what happen if the lessee want to surrender the asset early, right? So suppose asset can be surrendered early or not. Can he surrender it? It must also say what happen if the lessee want to surrender the asset early. Are there any penalty? How are they calculated? And under what circumstance the lease can be terminated? All these things should be there. And the contract must set out what count as a default and how dispute will be resolved. Sometimes arbitration clause dispute will be resolved. This will be written in the contract or a specified court is there. Now, if we talk about the legal matter, Indian property law like the Transfer of Property Act and the Indian Registration Act, right? So basically these law cover the immovable property. These law cover the only property, immovable property like land, building. Equipment lease are handled by the contract law, right? Remember, equipment leasing, they are handled by the contract law, right? They are handled by the contract law and may involve bailment rule under the Indian Contract Act. It may involve the bailment rule. For indirect tax, one more point is that okay, so I hope it is clear, right? For indirect tax, GST treat lease like a supply and is generally taxable, right? So GST, this is the indirect tax, right? For indirect tax, GST treat lease like a lease as a supply and is generally taxable. The exact GST rate depends on the types of goods or the services involved. For income tax treatment, that whether payment are treated as an operating expense or finance expense depends on the lease type and the applicable tax rule. So the question is how to differentiate between the finance lease and the operating lease. We have already discussed these two kind of lease, right? So income tax treatment, whether payment are treated as an operating expense or finance expense depends on the lease type and applicable tax rule. This affect who claim depreciation. Remember, the lessor normally claim depreciation on the asset and the lessee usually cannot. In the sale and leaseback deal, the buyer or the lessor can claim depreciation on the asset returned on value. Also note that for the lessor, lease rental are taxable income. For the lessor, just remember, lease rental, yes, they can show as a taxable, right? So friends, read these clauses carefully. They determine who can do what, who pay what tax, and how disputes are handled. So what are the key terms which we have seen in these two slides? We talked about the prohibited, prohibited activities. Yes, there are something called prohibited activities. So what is the meaning of prohibited activities? Means any action that the lessee must avoid. Then we have early surrender and payment. Right? Early surrender. Early surrender means what fees apply if the lessee return the asset before the agreed time and the method of calculating those penalty. Then we have termination condition, which means event that allow either party to end the lease, default and dispute resolution. We will see the terms so-called applicability of the law. What is the meaning of this term applicability of the law? So law, we have different kinds of law. So basically transfer registration act mainly for immovable property. You can see this transfer of property act, registration act mainly for immovable property. Equipment lease rely on contract law as well as the bailment, right, for provision related to the bailment. Then GST on lease. Leasing is treated as a taxable supply under GST. Exact rate depends on the asset and service category. Income tax treatment. I told you that tax treatment depends on the lease nature, whether it is a finance lease or operating lease, right? Whether payment are treated as an operating expense or finance cost, and this affect taxable profit and who claim the depreciation. And I told you that lessor usually take depreciation. Lease rental count as an income for the lessor. Sales and leaseback affect depreciation based on the asset written down value, right? So let me give you some example to make this concept crystal clear. Like suppose if you lease a photocopier and then let another firm use it for a fee, that is called subleasing. This is called subleasing. Then early surrender penalty. Here we have just discussed a term that is called early surrender penalty. If you surrender early, you have to pay penalty. Which means if you return a lease when after 1 year of a 3-year lease, the contract may require you to pay a fixed surrender fee or the remaining rental. Dispute resolution. Many contracts say any dispute will go to arbitration in Mumbai, and that tell you where and how dispute will be settled, right? So these are the points. So friends, let's revise the key points. So lease must specify any forbidden activity like subleasing and penalty for early surrender. Agreement must state termination, event, default and dispute resolution. Transfer of property or registration act apply mainly to immovable property. Equipment leasing is governed by contract and bailment principle. Then GST treat lease as a taxable supply. Rate depends on the asset or service category. Income tax treatment depends on lease type. Lessor normally claim depreciation and lease rental are taxable income for the lessor. Lease rental are taxable income for the lessor. We have already covered it. Now basically whenever a lessee pay lease rental, those payments are usually treated as an expense in the lessee book, right? They are treated like an expense. So lease rental are treated like an expense. Very, very important points. Now let's look at how the lessor record a finance lease. Very, very important. Accounting of lease transaction in the book of lessor. How he record it. So at the start of the lease, called the commencement date. So here you will see the word written here, commencement, at the start of the lease, also called commencement date. The lessor does not keep the asset as a regular fixed asset, right? What lessor do? He does not keep the asset. He does not keep the asset as a regular fixed asset. Rather, the lessor show what it expect to receive from the lease, which we call net investment, right? It shows the net investment. Again, I am repeating. Basically, we are talking about as the start of the lease. The lessor does not keep the asset as a regular fixed asset. Rather, the lessor show what it expect to receive from the lease, which means the net investment, right, as a receivable on its balance sheet. So the lessor show the net investment as a receivable on the balance sheet. It present them as a receivable. Okay. Now, if the lessor incurred initial direct cost to make the lease happen, for example, brokerage fee, so these costs are generally added to the net investment and reduce the income that lessor recognize over the time. So if there is an initial direct cost, so they are included in the initial measurement or the net investment and reduce the amount of total income recognized over the lease term. Remember it, very, very important. Next point, except where the lessor is the manufacturer or the dealer. Okay, there is an exception to it where the lessor is the manufacturer or dealer, right? Over the lease term, the lessor record the finance income. There is something called finance income. You can also call finance income as an interest, right? So what I'm talking about, that over the lease term, the lessor record finance income on the receivable. Okay, receivable means what? Receivable means some basically this particular lessor, he has given some amount, some he has leased some asset and he is getting money quickly. He has not get money, money is due. That's called receivable. So what I'm talking about, that over the lease term the lessor record the finance income. So this is kind of finance income, that's called interest on the receivable. The income is recognized so that the lessor earn a constant periodic rate of return. So it reflects a constant periodic rate of return. The lessor earn a constant periodic rate of return on its investment. In other words, each period interest is calculated on the outstanding receivable using the same implicit rate. So what are the key points which we have covered in these two slides? We start with the lessee. I told you that lessee lease rental as expense, right? So what is the meaning of this term? Let me explain. It simply means for lessee, regular lease payment are treated like a rent and charged to the profit or loss. Then we talk about the commencement date. Here you can see the word written here, commencement date. What is the meaning of it? So basically the date the lease start and accounting treatment begins. Then we talk about the net investment in the lease. What does it mean? So the present value of the future lease payment plus any guaranteed residual. This is what the lessor expect to receive. Yes, that is called the net investment. Means whatever future rental payment you find their present value, add all of them, right? So that is what lessor is expected to receive. Then we talked about the interest rate implicit in the lease, right? Here you will see interest rate implicit in the lease. What does it mean? It means that rate that make the present value of the lease payment equal to the fair value of the lease asset. Then we talk about the receivable. You will see the word written here, receivable. What is the meaning of this? Receivable means lessor. Basically, instead of showing the physical asset, a lessor under a finance lease shows a receivable equal to the net investment. Then we talk about the initial direct cost, right? What is the meaning of this term, initial direct cost? So initial direct cost means what? That upfront cost of arranging the lease, commission, legal fee that are usually added to the lesser net investment. And then we talk about the finance income. Finance income, the lessor recognize interest income over the lease term so that each period yield a constant rate of return on the outstanding net investment. So let me illustrate it using some example, right? So because unique example, you can easily understand all these things. Think of a bank buying a photocopier, right? Suppose a bank buying a photocopier and leasing it to an office. Bank buying a photocopier and leasing it to an office. So the bank show it on its book, the amount it expect to get from the office. Yes, this particular bank being the lessor, it shows on the book that this much amount I am going to receive, right? It will calculate the present value of all the future payment, right? It will show that yes, this much amount I'm expecting to get from the office seat, right? So this bank will show it's in its book the amount that it will receive, and it uses the lease built-in interest rate. It uses the lease built-in interest rate. It uses the lease built-in interest rate to split each monthly payment into interest income and principal repayment. So it uses the built-in interest rate to split each monthly payment into interest income, either interest income or principal repayment. Right. So whatever built-in interest rate, it uses the lease built-in interest rate to split each monthly payment into interest income and principal repayment, so that bank earn a steady return over the time. Any brokerage charge the bank paid to arrange the lease is added to what it expect to recover and reduce profit split over the lease term. So friends, what we have discussed here, for lessee, lease rental is an expense. For lessor, they show the receivable as a kind of net investment. Interest income at a constant rate on the outstanding receivable. So remember the keywords which we have covered in these two slides. I told you that lessee, lease rental are treated like an expense. Lessor, for finance lease, they recognize the receivable or the net investment at commencement and measured using the interest rate implicit in the lease. There are some initial direct cost. So initial direct cost, except for manufacturer or dealer, right? Initial direct costs are included in the net investment and it reduces the income recognized over the time. And lessor recognize the finance income over the lease term using a constant periodic rate of return. So what I told you, that lessor recognize the finance income, right? Lessor recognize finance income over the lease term using a constant periodic rate of return. Now let's look at the next slide. So friends, let's see how the lessor record a finance lease using a simple example. And the same thing has been shown here. Till now it was all theory. It was all theory. Now let's see one simple example that how the lessor record as the finance lease. Suppose take the case of ABC Limited, right? Take the case of ABC Limited. What it does, it buy a machine for 100 lakh rupees. It buy a machine for 100 lakh rupees, right? And lease it to XYZ Limited. Fine. Now what happened? That for 10 years, right? It leases for the period of 10 years. Now the lease rent is 18 lakh rupees per year. Yeah, you can see it here. Lease rent is 18 lakh rupees per year, and also useful life is 10 year. Useful life of the machine is 10 year they have given. And one more point is that at the start ABC does not show the machine at the fixed asset on its balance sheet, right? So what happened that at the start means at the commencement date, which means at the start ABC is the lessor, right? Lessor, he buy a machine and his leases to the XYZ Limited. So at the start ABC, who is the lessor, it does not show the machine as a fixed asset on its balance sheet. Instead it shows what it expect to receive, which means the net investment. So at the start ABC does not show the machine as a fixed asset on its balance sheet. It shows what it expect to receive, that is the net investment or receivable. So what it showed in the balance sheet? It showed the net investment. It shows the net investment, right? Now the question is asking you how this lease will be treated in the book by ABC Limited. Very good question it is, right? So apply this 10% discounting rate, and here is given the interest rate implicit in the lease is 10% per annum. Apply the 10% discount rate. The present value of the 10 annual payment of 18 lakh is how much? See, for a period of 10 year, right? For a period of 10 year, he will get 18 lakh per year. Think about it. First year 18 lakh, second year 18 lakh, until 10 year 18 lakh, right? You find the present value of the 10 annual payment. You can think of it like this: 18 lakh first year, 18 lakh second year, 18 lakh third year, till 18 lakh 10th year. You have to find all of their present value. Just apply the formula which we have discussed in the previous lecture, finding the present value. And if you calculate them, you will get the present value as 110.61 lakh, right? So ABC will present a lease receivable. This is called what? This is called lease receivable. This ABC will call lease receivable. Present value of all the future cash payment, that is called lease receivable. How much it is? 110.61.